A very good morning, everyone, and a very warm welcome to all of you on behalf of the Institute of Chartered Accountants of India. Well, my name is CA Bilasha Mudgal, and I would like to welcome you all in today's webinar on manufacturing industry, which organized by Committee for Members in Industry and Business of the ICAI. So today we have two speakers, CA Achal Jain sir. Sir will guide us on accounting and auditing issues in manufacturing industry, and CA Arvind Daga sir, who will guide us on impact of Ind AS in manufacturing industry. First, I welcome you, sir. So now I am profoundly delighted to take an opportunity to introduce the speaker, C. Achal Jain sir. Sir is a chartered accountant and having experience of more than 17 years in same field. Sir is assisting clients in manufacturing, real estate, power, construction, services, software, media, and many more. He has worked on various publications for Big Four, which covered various aspects related to Ind AS and IFRS. Sir is active speaker with ICAI and NAFRA for Ind AS and other training programs. Sir is a member of study groups of ASP and AASP and technical reviewer of FRRB of ICAI. Sir, I request you to please enlighten us by your profound knowledge. Please, sir.
Sure. Thank you so much for this. And thanks everyone for sparing time for having discussions as around this topic, which is around the accounting as well as the auditing aspects in the manufacturing industry. I would say this industry is such that there are a lot of subsectors which get covered within the purview of this particular sector when we talk about manufacturing, because manufacturing could be related to anything. Manufacturing could be related to the automotive parts, manufacturing could be related to the metal segment, manufacturing could be related to some of the FMCG products that we discuss here. So there's a wide ambit which is getting covered within this sector. And because I've been requested to speak on the accounting and auditing issues, and after which I also understand that the discussion is going to happen as around the Ind AS aspect in particularly. So I'll just try to restrict my discussion more specifically to the auditing issues rather than the accounting issues, because that is something which is going to subsequently follow as we move forward. Now, talking about the manufacturing sector, first of all, I would say the key aspect for any sector, and not only restricted to the manufacturing sector, when it comes to the auditing aspect, wherein the financial reporting process is required to be reviewed, happens to be the process of an organization. And as around the process, we can say is about the understanding of that particular industry or understanding of that particular company. So we are going to discuss some of the points around it first of all, and then we'll move on to some of the other key aspects when we move on to the manufacturing sector in particular. So let me just share one presentation also around this. All right. So now when we talk about the auditing issues, and I think this becomes very, very relevant from the perspective of management also, because it's not only the auditor who is required to get involved in the auditing process, it's also the management, because their financial reporting is sort of incomplete till the time this is really audited by the auditor. So that's why this is an area which is required to be focused upon both by the auditor as well as the management. So considering that part, one of the key procedures which every auditor requires happens to be the understanding of the industry. So now when it comes to the understanding of the industry, it is very, very important. Yeah, and from the management side also, it is very, very important for them to pass on this knowledge to the auditor, because till the time this understanding of the industry is not available to the auditor, they will not be able to design their audit process. They will not be able to design their audit procedures around it. And similarly, understanding of that particular company which is required to be audited also becomes very, very important for the auditor, or I would say the audit team. And there again, the role of the management becomes very, very important. Why? Because it's the management which has to pass on that relevant understanding to the audit team. Because if the audit team will be well versed, they will have this complete understanding about the industry as well as the company, Only then they will be able to come up with the required audit procedures and of course the relevant audit procedures. Because many a times as a management, what do you feel? We feel that there are a lot of questions, there are a lot of queries which are coming from the audit side which are not really relevant for the company or for the industry, and those sort of I would say inefficiencies or those sort of irrelevant aspects in an audit process can definitely be cut down by having this joint discussion with the audit team wherein this knowledge of the industry and the company is passed on to them. So this is the first aspect. Now when we talk about the knowledge of the company, now let's try to understand as to what do you mean by the knowledge of the company or the knowledge of the industry per se. So now, when it comes to the knowledge of the company, I would say company comprises of various processes using which a lot of activities are carried out. For example, if we talk about procurement, that is one of the process in an organization. Similarly, if we talk about capitalization, that is one of the processes in an organization. Similarly, if we talk about sales and marketing, that is again one of the process of an organization. Okay. Now, if a person or if an auditor or if anyone has to understand about the company, so this understanding of the company has to come through the understanding of the processes of of that company. And what are those processes? Like we just mentioned. Okay. Now, when we talk about the manufacturing sector or the manufacturing company, one has to understand that the key area in respect of any manufacturing company has to be related to inventory. And when we talk about the inventory, so we must also include the process of procurement therein, because inventory is nothing but a built up of this procurement process, which is then at times converted into the finished goods also through a process which is there in the organization. And this is the process over which the understanding of the audit team becomes very, very important. Yeah, so whenever this audit is required to be planned or this is required to be understood, it becomes important on the part of the management to pass on this understanding of the process to the auditor. Now let's try to understand as to what do you really mean by the process of this procurement. Now, what would this process cover? And what sort of understanding is required to be, first of all, established by the management and then, of course, passed on to the auditor. So when we talk about the process, and if we speak about the procurement process now, so this process basically is about various activities which are involved in the procurement process and which reaches up to the stage till the time inventory is readily available. So when we talk about purchase as an activity, that is a part of the procurement process. When we talk about purchase of raw material, which is then converted or which is then moved to a conversion process, wherein there could be various stages depending on the type of manufacturing process which an entity may be following. So the raw material will pass on to a stage of work in progress, and from work in progress, it will pass on to the next stage of finished good, which is then available for the final sale to the customer. So all of these activities, I would say, will be the one which get covered within this procurement process and which reaches up to the stage of finalization of inventory. Now, because the area inventory is very, very critical for any manufacturing company, so that's why any auditor would want to focus on all of these activities which revolve around this inventory. Yeah. So now, first part is that the auditor should be able to understand as to what all activities management has been following in respect of this process. The second part is around the controls and some of the risks which may be related to that particular process. So if we talk about procurement process, let's try to understand as to what do we mean by risk and what do we mean by the control. Because as a management, it is again important for us to establish that system within the organization. Now, many a times you must have heard this term RCM, risk control matrix. And I'm sure most of you must have been worked or working on this RCM in respect of some of the activities or some of the roles and responsibilities which you may be executing during the uh, process of your activities within the organization. Now, this risk control, what is this risk and what is this control? Let's try to understand that. Now, risk is something which is going to create a possible error in the financial reporting. Okay, so any activity which may create an error in the financial reporting can be considered to be a risk. For example, purchases have been made for which an invoice has been received. Okay, so there is an activity. What is the activity? Purchases have been made and the invoice for those purchases has also been received. But there is a risk. Now, what is the risk in this activity? That the goods have not been physically received by the organization. Is it possible? The answer is yes, it is possible. That it may happen that even though purchases have been made, but physically the goods have not been received. So, is this a kind of risk which is there? The answer is yes, it's a risk. Now, as a management, it becomes important for us to list down and to just ensure that all of these types of risks which are possible in a particular activity, in a particular process, are first of all identified. Once the risks are identified, the next step on the part of the management happens to be the establishment of control, which will take care of those risks. Now, for example, if we talk about the same risk, that the invoice has been received for the purchases of goods, but the goods have not been physically received. Now, what can be a management control as around this particular risk? The management control as around this particular risk happens to be the establishment of one process, or you can say one activity, wherein the invoice will not be processed or invoice will not be accepted till the time there is a physical receipt of goods along with that invoice, and which is physically verified by the, say, the gatekeeper, or say the stores in charge. Now, by doing this, what will happen? The risk which was there earlier, that the goods have not been physically received, but it may happen that the creditor gets recorded. Why? Because the purchases are getting recorded by only receiving the invoice. So this risk will go away. Okay. Now, similar to this, every process will have lots of risks, and against all of those risks, various management controls will have to be established. Yeah. This is something which we also do in case of a risk control matrix. Now, why is this important for an organization? First of all, because if the organization has to function and their processes have to function in a smooth manner, it is only possible when all of these activities are put in place, wherein all of these risks and controls have been taken care of. Secondly, once this is established by the management, the auditor would also want to verify this during his audit process. And that's why when the auditor will start his audit activity, means when he will be into his audit planning stage, at that point of time, if this entire understanding is passed on to the auditor in respect of activities, in respect of controls which are possible, which have been identified by the management, and which have also been taken care of by the management. And how have those been taken care of by the management? By setting up management controls. Then the auditor will get first level of comfort that the operations are working in a manner wherein the controls have been put in place, And the auditor would also want to then verify that the controls are operating effectively. But for that verification to be done, this understanding has to come at the first place. And for this understanding to be given to the auditor, it's very important that the management should have the system in first place. Okay. Now, by doing this, the first level of comfort can be derived by the auditor. And of course, if the management controls are operating in an effective manner, then the extent of the audit procedures which any audit team would want to plan will definitely be cut down in respect of the subsequent testing which the auditor would want to perform. Okay, so that's why I would say this process and the understanding of the process and the various activities which are involved in that process is the key or is the first step, not only for the auditor but also for the management. Now, sometimes some of the challenges that we face, let's try to understand. It may happen that the management has a process in place. Management has also got the risks identified. They also have the controls, but these are only documented at times. Okay. If you look at the controls, they may not be operating effectively. Okay. Why? Because it's there on the piece of paper, which doesn't really work. Yeah. But if that is the case, is that of any use to the management or to the auditor? The answer is no. Yeah, and that is something which is going to pose challenges to the management at the time of audit. So that's why it's very, very important that the process or this entire activity which we have discussed is not only documented, but this is also operating in an effective manner, which has to be taken care of by the business or the management first of all. The other challenge, which at times is also seen and most commonly seen, happens to be the fact that the management may have a process, they may also have the controls which are also operating effectively, but these are not documented. Okay, so now if the auditor has to come, or if the auditor has to perform the procedures around it, or if the auditor has to understand all of these aspects which we have just discussed, so there's nothing which is documented. Now, if the auditor is then required to be educated in terms of the understanding of the auditor as around these aspects, how is that possible then? Only and only when there is a one-to-one discussion between the management and the auditor. Yeah, because till the time it is not documented, auditor will not have any other mode but to have this entire discussion, which has to be a thorough discussion with the auditor, basis which he will be able to then understand as to what is really going on in the organization, which he can then plan as part of his audit procedures and accordingly design his next step of action. Okay, so in a manufacturing sector, I would say, considering the fact that this inventory is very, very critical, so that's why this process as around procurement becomes again very, very critical for the company. The second aspect, particularly in case of the manufacturing sector or any manufacturing company, happens to be the physical verification. Now let's try to understand, because I would say this is an extremely important procedure for any auditor and extremely important activity for any management. Now, when it comes to the inventory, which generally comprises a significant part of financial statements of any manufacturing company, there's one aspect of this inventory which can only be audited or which can only be verified by physical verification of inventory, and that happens to be the existence of the inventory. So now, if as the management or if as the auditor, one has to ensure that whatever inventory is recorded in the books of accounts, whatever inventory is appearing in the financial statements as at the particular reporting date, physically exists or not. Okay, means that is in existence or not. How is that possible? By performing only one procedure. And which procedure is that? That happens to be the physical verification of inventory. Okay, which is called by different names, wherein we talk about the stock verification, or we talk about physical verification, or we talk about the stock take, yeah, and which is usually carried out towards the year end, which happens to be around 31st March. So in some of the cases, we start before 1 week before 31st March, and in some of the cases, it goes up to 1 week or say 10 days after 31st March. Yeah, so it depends on the type of production process which the organization may be performing, but an extremely important activity. Now, as around this activity, let's try to understand some of the challenges which as the management we face, which as the auditors we face. Now, if we talk about a small size company or a medium size company, for them to physically verify this inventory towards the year end is something which is again not very difficult, I would say. So usually what will happen, auditor may want to perform this physical verification say on 31st March, or say on 1st of April or 2nd of April, and usually it will be completed within a day or two. But when it comes to the management side, it's something which may take more than 1 or 2 days, because they would want to carry out this physical verification on 100% basis, as against the auditor who will be physically verifying the inventory on a test check basis. Yeah, because for an auditor to 100% verify this inventory is something which is not required to be done and not practically feasible, both for the management as well as for the auditor. Now, at times, it may happen, particularly in case of large companies and which are also spread out across various locations, that this physical verification is not really possible within a day or two. Okay, and it may have to be spread out over a large number of days. Say this process of physical verification may take 7 to 10 days. Okay, now a question therein arises as to how should this physical verification be really carried out. And I'm just talking about this physical verification more from the audit side now, because as we discussed for the management, this physical verification has to be done on a 100% basis. Yeah, for them to get the comfort as around this complete availability of the stock in place. Now, for an auditor to plan such activity in respect of the physical verification, now, as we discussed, that auditor will not be verifying this inventory on a 100% basis. So what will they do? Now, for an entity for which the inventory is all spread out at multiple locations, of course, auditor will do this ABC analysis. Now, what do you mean by ABC analysis? A means the large ticket items or the inventory which is for high value. B means the medium ticket items, means which are of the middle range, which are not of very high value. And C, of course, is all about the low value items, wherein the larger chunk of the physical verification which the auditor would want to perform will be on the A category items, and bit more on the B category items, and a smaller proportion from the C category items, so that he can just uh, capture a larger pool when it comes to the physical verification. Now, by doing this, what will happen? Auditor will cut down on the size of this inventory, which is then required to be physically verified. So this is point number one. The other point which arises around various locations, that is again sort of managed by the audit team by looking at that ABC analysis, or by looking at those locations which he may want to cover, maybe on a rotational basis, maybe in a particular quarter he's just verifying some of the locations, and then in the next quarter he's verifying some other locations. Okay, so it's going to be a rolling cycle uh, basis which he may want to cover, say, all the locations or majority of the locations within a year, or within a rolling cycle of say 2 to 3 years. So that is generally how the physical verification is required to be planned, and accordingly the management also needs to have this discussion with the auditor as around the physical verification. At times, one may also see that in case of some of the manufacturing companies, which also happen to be the large size companies, this physical verification may require involvement of an expert. let's try to understand as to why this is relevant and how this may really impact the physical verification. See, when it comes to the physical verification or the stock take, what do you generally understand about it? We understand as if we'll just go, we'll just check the stock as to what is there, we'll just count the stock which is lying at a particular location, and by counting the stuff, the physical verification is completed, which is accurate. Okay, there is absolutely no problem as far as this understanding is concerned. But at times, some of the companies could be there for which this counting is not possible. Okay, so you can just it's not possible for you to just go and count the inventory. Why? Because the nature of inventory is different. For example, if we talk about some of the raw material which could be there in the liquid form, okay, some of the items, for example, if we talk about the steel sector, okay, so this raw material which is available over there, yeah. So now, in respect of such type of inventory, the physical verification is not something which is possible by the management as well as by the auditor. Why? Because an industry expert may have to be engaged. Why that industry expert may have to be engaged? Because he will understand as to how this physical verification has to be done, and which is absolutely not a problem. And many a times you see that some of the large companies who have this nature of inventory, they engage industry experts, okay, or they engage experts who are regularly carrying out these type of physical verifications. And by doing this, what will happen? By doing this, the first thing is that the physical verification which the management would do for their reporting. Okay, why? Because financial statement belongs to whom? The company. So this physical verification will be carried out in an appropriate manner. Second aspect is this will also give an additional level of comfort to the auditor. Why? Because when he will have to design his audit procedures, he will also be inclined to understand as to how the management is doing this physical verification. And when the auditor will have this comfort that the management is engaging an expert for the purposes of physical verification, yeah, so the comfort of the auditor as around that particular physical verification exercise is going to increase. Okay, why? Because auditor may not be the expert in terms of this physical verification, and he also understand that the management is also not an expert. Okay, or maybe even if the technical team is involved, they are not so expert as against the expert which is engaged by the management. At times, even in these cases, when the management expert is involved, auditor may also want to plan his own expert for the purposes of this particular exercise, which again is not a problem at all. Yeah, which is absolutely not a problem. So if the management has involved an expert, so is it possible that the auditor may also plan to have an expert for this physical verification? The answer is yes, and which is again not a problem. But one has to understand the fact that irrespective of whether the management is involving an expert or not, or the auditor is involving an expert or not, who carries this responsibility for the preparation of the financial statements? It's the management. So if they have an expert who has done this physical verification, and the impact of which is going to be recorded in the financial statements, can this be passed on to that expert by the management saying that this physical verification was performed by them? The answer is no, because eventually it's the company who is responsible for the financial statements. Similarly, when it comes to the audit, wherein the expert is involved by the management or maybe by the auditor also, in that case, can the auditor just run away from his responsibility for the opinion as around the financial statements or as around this particular piece of inventory in the financial statements by just saying that this particular activity was carried out by an expert and that's why he is placing a reliance on this? The answer is yes, he can place a reliance on this, but the end responsibility for this particular item in the financial statement will also be there on the auditor. Yeah. So that's why even though experts are involved, it is essential for the management as well as the auditor to remain involved in this exercise during the course of this physical verification. By doing this, they will be able to understand the challenges which are involved. They will be able to understand the complexities, if at all those are there, and they will be also able to discuss and understand the final resolution as to how those are really required to be taken care of when it comes to the financial reporting. Again, a very, very important aspect when it comes to the inventory. And in case of inventory, as we discussed, this physical verification aspect is one of the key elements. Yeah. And you'll not see any company, particularly into the manufacturing sector, wherein this physical verification is not carried out. Okay. Generally, you see this happening at the year end, but in some of the companies, particularly in those companies which have got huge volumes of inventory, which are large size and which are also spread out at various locations, this physical verification may not really be performed towards the year end only. These companies may again have a process of carrying out this physical verification throughout the year. So when I say throughout the year, it doesn't mean this has to be done 365 days. Throughout the year means it's spread out over the period, over the year. And this may also be spread out not only over the year, this may be spread out over a rolling cycle of say 2 to 3 years, wherein at least the majority part is covered within a particular financial year. Okay, that again depends as to how the management has really planned this entire exercise, depending on the complexities which are involved, depending on the production processes which are there within the organization, and depending again on the size and the complexity of the items which are which are required to be therefore physically verified. So all of these aspects are required to be looked at. Now comes a question that if the auditor is involved in this physical verification, okay, wherein he is just performing an audit of this particular area and for which the existence is required to be verified, and when is this existence required to be verified? That has to be the reporting date, because eventually the financial statements have to be prepared as at 31st March. Okay. Now, in a particular case wherein the physical verification is happening at different points of time during the year and not really as at 31st March. Okay. Why? Because the size of the inventory is such that this is not really happening as on 31st March every year. Okay, very, very difficult. Now, in that particular case, a question arises that how do we check the existence of the inventory as at 31st March? Or can we say that we are not really checking the existence of the inventory as at 31st March? The answer is no. Why? See, when it comes to the physical verification, it is not a rule or it is not something which is a mandate that this has to be done on 31st March. Of course, the existence of inventory has to be established as at 31st March. But for this existence to be established, what is the auditor or the management doing? They are physically verifying the inventory, which may not be done as at 31st March. That may be done before 31st March or after 31st March. But if those are performed at different dates, what is the next set of procedure which is then required to be performed by the management as well as the auditor? That is called as roll forward or roll backward procedure. For example, say the stock take was carried out on 7th of April. So now the physical verification has happened on 7th of April, but we want the existence to be checked as at 31st March. So how do we really go back to 31st March? So this rollback procedure, okay, will have to be performed. Now, what do you do in this rollback? So the physical verification is established on 7th of April, and between this period of 31st March to 7th of April, entire movement which has taken place in the inventory, this needs to be verified by the auditor. Because if this is verified, then of course we have this walk from 31st March to 7th of April, and on 7th of April, the existence has been verified by doing this stock take. Similarly, say a company which carries out physical verification every quarter, or say which carries out physical verification in the month of December. Why? Because their activities are such, it's easier for them to stop the production process, because the production process is complex. They don't really want to plan this towards the year end. So is it possible for them to do this in December? And if they do this in December, what is the course of action for the management and the auditor? The same sort of exercise will then have to be performed. Why? Because if this is performed, say, towards December end, as against the 31st March period, then the existence has been verified in this particular month. Okay. And the roll forward procedure, which would be establishing the walk from 31st of December to 31st of March, will be necessary, will be required on the part of the auditor. And then subsequently, what can the auditor do? Instead of doing this significant physical verification, which he might have been performing as at 31st December or in the month of December every year, he may want to do some limited physical verification procedures, or physical verification procedures on some limited items towards the reporting end, okay, which is around 31st March, basis which he will then be able to again carry out this procedure as around the physical verification and as around the roll forward procedure, so that he is then able to establish the existence of the inventory, which is then going to be recorded in the financial statements. Okay, again, I would say a very important area for any manufacturing company. Then we move on to the next aspect, that is about the valuation. Now, when we talk about the inventory, then of course, valuation is again going to play a very, very important role in respect of any manufacturing company. Now, as around the valuation, this valuation aspect is something which is a big challenge. So, if we talk about any company, any management today, valuation happens to be a very, very typical and an exercise which takes up a significant effort on the part of the management and also on the part of the auditor. Why? Because there are going to be a lot of challenges as around this valuation exercise. So let's try to understand what are those challenges, what are those complexities, and how do we really deal with them. See, when it comes to the valuation, let's try to understand as to how do we really reach towards this inventory which is recorded in the financial statement. So basically, we are talking about measurement of inventory. Now, this inventory which is recorded in the financial statements will have some cost components, and which are prescribed by the accounting standards. So be it Indian GAAP, be it Ind AS, yeah, so both of them are aligned as far as the accounting requirements are concerned. Any cost which is incurred in respect of an item of inventory till the time that item is not ready for sale, till the time that item is not ready for sale, is allowed to be capitalized to the cost of inventory. Okay, so this is, I would say, in simple terms, the principle one has to follow in respect of measurement of inventory. Now, when it comes to the raw material, of course, they will be measured at the purchase cost generally. But when it comes to the WIP, work in progress, wherein the raw material is into the conversion stage, but the conversion is not completed, or when it comes to the finished goods, in respect of these two items, particularly, some of the costs are incurred by the company, which are also added to these particular items, which create complexities, as far as this valuation process is concerned. Okay. Now, in respect of this, let's try to understand the measurement principle which is prescribed by the accounting standard. Accounting standard says that the cost which can be loaded on the inventory could be of two types. One is the purchase cost. When we talk about the purchase cost, means the purchase price minus the discount minus the refundable taxes plus the non-refundable taxes. Okay, so this is something which is going to be the purchase price, which is easy for any management to be looked at and any auditor to audit. The second aspect is around the directly attributable cost. Now, what is this directly attributable cost? Directly attributable cost means any cost which is incurred specifically for manufacturing of that particular item. Now, when this conversion process will be going on. Now, what is this conversion process? Production process is going on. Okay. Other than the purchase price, there are a lot of costs which are incurred. Let's try to understand those costs. Labor will be involved, means employees are involved for the production process, which are working dedicatedly on the production of the inventory. Now, because this cost is incurred specifically for the production, so what does it become? Directly attributable cost. And what do we do with this cost? This is added to the cost of the inventory. Similarly, if we talk about any professional, any consultant, or any third party consultant who is providing the resources who are also involved in the production process, what do we do with these costs? Because these are directly attributable to the production process, so that's why they will also get loaded to the cost of the inventory. Third, any infrastructure which is used during this production process. For example, machinery will be involved in the production process, correct? Yeah, building will be involved wherein this production process will be carried out. Now, there are two ways which are possible as around these types of infrastructure. One, the infrastructure is taken on rent. For example, building is taken on rent. Some of the machines have also been taken on lease. Generally, machines are procured, means those are purchased, but let's assume these are taken on rent. Now, because this infrastructure is dedicated to the production process, that's why this rental cost, which is incurred by the organization, is towards what? Towards the production process only. So what do we do with this rental cost? This will also get added to the cost of the inventory. Okay. Let's suppose there is another scenario wherein the building is owned by the organization. Machines are purchased and owned by the organization. Now, do we have a rental cost in such a case? The answer is no. But in such a case, these machines or these equipments or this building, they are getting depreciated. So there is a wear tear. Yeah. They are getting depreciated. And this cost of depreciation is what? This is again incurred on this particular infrastructure. And where is this infrastructure used? That is dedicated to the production process. So what do we do with this depreciation cost? That will also get added to the cost of the inventory. Okay, yeah. So these are some of the items that I discussed with you, which are generally required to be looked at by the management when it comes to the valuation of the inventory. And I'm sure many of you would be able to relate with this. If we look at today's scenario, most of the companies, even if they are on ERP, they are on SAP, they are on Oracle, when it comes to the valuation of the inventory, this is done outside the system. In most of the cases, I would say 99% of the companies are doing this valuation outside the system, or at least some part of valuation is done outside the system. Means some sort of manual intervention is involved. And the moment we say this manual intervention is involved, so considering the size of the uh, this item means considering the size of the inventory, this exercise becomes complex. Okay. And when the manual intervention is involved, there are chances of error. So that's why a lot of attention is required on this particular exercise. And similarly, a lot of procedures are required to be carried out by the auditor. Yeah, so that's why a joint discussion and a joint exercise as around this valuation exercise between the management and the auditor becomes extremely important if one has to really look at the correct valuation, which then gets reported in the financial statements. The other aspect, which is again important for one to understand around this valuation aspect, is about various other costs. Okay, and I'm sure you must have dealt with this, that when it comes to a lot of costs which form part of the valuation of inventory, even though I just touched upon some of the simple examples, many a times we come across some of the items which are loaded on the cost of the inventory and which are then challenged by the auditor. For example, if we talk about salaries of corporate staff, okay, so if we talk about some of the salaries of the accountants, okay, and similarly if we talk about some of the items or some of the depreciation amount of some of the other items which are not really dedicated to the production process, so how do we really deal with them? Okay, now for this to be assessed and for this to be finalized as far as their allocation in terms of the valuation of inventory is concerned, one has to always go by the principle we have discussed. What are the principles? One, any cost which is incurred till the time inventory is ready for sale, and if that is in the normal course of business, that will get added to the inventory, provided it is directly attributable to the production process. Okay, so if we come across any of these costs or any cost which is not directly attributable to the production process, can that be added to the cost of the inventory? The answer is no. That should not be added to the cost of the inventory. Now comes a case of, say, some of the team members or some of the employees who are working on two activities. Okay, say an employee is there, he is working partly on the production process and partly on some other activities. Now in such a case, what do we do? In such cases, you must have seen a proportion is generally looked at, a proportion is generally derived, wherein it is assessed that that particular employee is devoting 40% of his time on the production process and 60% on other activities. So in such a case, 40% cost of that particular employee is added to the cost of the inventory. Very, very commonly seen in case of corporate costs, which is again required to be first of all thoroughly assessed, because there is no really rule which is available over there, but this principle has to be always looked at. And that's why I'm saying a lot of challenges arise in respect of valuation and the cost allocation, particularly from these aspects which one has to always take care of. Yeah, so this is about the cost allocation, which is again very, very important exercise as far as the inventory valuation is concerned. And when we talk about the inventory valuation, some of the other aspects which are required to be looked at happen to be the comparison, or you can say review of this inventory towards the year end. Because whenever the inventory is recorded, so this inventory will always be recorded at cost, but towards the year end or at the time of reporting, standard means the accounting standard also requires that it should be checked whether this cost is below net realizable value or above net realizable value. Because if the cost is above net realizable value, then the inventory will always be carried at cost. But in case there are some of the items which are there in the inventory which have gone, for which the NRV or the net realizable value has gone down as compared to the cost, then all those items are required to be remeasured at their NRV instead of cost. And where do you take this impact? This impact will eventually go to the P&L. This impact is required to be taken to the P&L. Okay, so both these aspects are required to be looked at, and which are again very very important, and this exercise has to be carried out on an item by item basis. So you just need to review all of these items towards the year end, and you need to also check as to how their valuation will get impacted. The next aspect, because this is again related to the inventory, could be in respect of stores and spares. Now, stores and spares are also generally found in case of a manufacturing company, and they are also significant in terms of their size, in terms of the amount which is involved. Now, if we go by the old practices, okay, and I would really say this to be a practice now, because when it comes to the accounting guidance, so the accounting guidance, whether it comes to the Indian GAAP or to the Ind AS, both of them are again aligned as far as the accounting requirements are concerned. So if you look at the old practices, the moment we talk about stores or the items of stores, generally what do we see? That these are appearing in the inventory head. So they are forming part of the inventory in case of an organization. But if one really look at the requirements of the Ind AS or the accounting standard, now what does this principle say? When we go to property, plant and equipment, it says if there is an item which is expected to be used for more than one period, and this period is 12 months effectively, yeah, which is expected to be used for more than 12 months, then such an item becomes PPE. Okay, yeah. Now, what do you mean by expected to be used? Basically, we are talking about the useful life here. Because what is useful life? That is the expected useful life, because it's more of a management estimate. Now, considering that aspect of property, plant and equipment, let's try to understand the impact which may arise in respect of some of these items related to stores and spares. Say if the company has got stores or the items of stores which are expected to be used for more than one reporting period, for more than 12 months. Now, what will happen in such a scenario? They may qualify the criteria of property, plant and equipment. Yeah. And the moment they qualify the criteria of property, plant and equipment, what would happen? They will not be kept in inventory, or they should not be recorded as inventory. That should get recorded as property, plant and equipment. Now, property, plant and equipment is a nomenclature which we use for fixed assets now. And as we discussed, that this guidance or this requirement is not really there in Ind AS now. This is also there under accounting standards. So both the gaps are allowed. So now again, this is one aspect which the management needs to take care of. And if you come across a lot of companies, so I would say that this area is not really looked at by the management as well as by the auditor, and that's why it's very very important for both of them to look at both these aspects, because if there are any such items, so it's not only the classification which is going to become a problem, it's also about the eventual impact on those items. Means if those items will become PPE, so what will happen? They will also get depreciated over its useful life. So that impact also needs to be analyzed and looked at by the management, right? Moving further, and I would say, which is again something similar in lines, because we are more focused towards the inventory, because that is something which comprises a significant part of the manufacturing sector, is about the review of certain items. And this review is more relevant from the audit side, but again, this is something which the management should also be looking at. Why? Because then the audit process can then be sort of streamlined, because if the management will be carrying out these processes internally, they will also be understanding the expectations of the auditor. Now, first aspect is about the review of cost of goods sold. Now, generally, when it comes to the review of cost of goods sold, what do? We just do a comparison of year on year numbers, and this is considered to be a good enough procedure. But is that really an adequate procedure when it comes to the audit of cost of goods sold? The answer may be no. Why? Because it's a significant item. When it comes to a manufacturing company, you will generally find this to be a significant item which is appearing in the financial statements of any manufacturing company. So that's why, just to limit ourselves by doing a comparison, okay, so wherein we are just checking the variance as compared to the previous year, may not be a good enough procedure. So there are some other procedures which are also required to be looked at, as around the verification of cost of goods sold. Let's try to spend some time on some of these procedures. Of course, as we discussed, that this GP margin, yeah, this GP margin, gross profit margin, which is again very relevant from the perspective of cost of goods sold, or from the perspective of a particular company, is required to be looked at. So this analysis has to be performed as to how these margin have been fluctuating year on year or period on period. So this will give an insight to the auditor, to the management, as to how the things are really changing, and what of the things are really changing internally in terms of the processes, in terms of the production process, or in terms of the procurement process, which can then be focused upon by the management as far as any error is concerned, if at all it lies in the financial reporting. Second aspect is that when it comes to the production process, now for any process, standardized process. Okay. For example, if one has to manufacture a particular item, there will generally be a standardized process. Now, what do you mean by standardized process? You can also say it's a sort of a recipe. Okay. That for manufacturing this particular item, how many items of X raw material is required, how many items of Y raw material is required, how many items of Z raw material is required, and which is then composed or which is then processed, basis which the end product will be manufactured, and which in technical terms is considered to be a, or which is called as a bill of material, BOM. Okay. Now, when it comes to the review or the verification of cost of goods sold, what is it this is required to be done over and above this variance analysis, over and above some of the analytical procedures that we perform? The review of this BOM. Now, for an organization, the BOM may not be limited to one or two. So if we talk about large companies, or even if we talk about the medium-sized companies, they may be having multiple BOMs. So is it that the auditor is required to review each and every BOM? No, the answer is no. This again will be done on a selection basis, wherein the sampling technique will have to be looked at, wherein again some of the BOMs need to be pegged up, basis which it needs to be verified as to how the composition is changing, if at all that composition is changed. And if that composition is changing, how is that impacting the financial numbers? Or is the impact which the auditor has looked at by doing this comparison of the previous year numbers, or by performing some of the analytical procedures, in line with what is reflected by BOM, or what is reflected by the change in the composition of BOM? Yeah, this is again, I would say, a very important procedure on the part of the auditor to look at. Why? Because by doing this, what will happen? The auditor will get an insights of the quantity as well as rate, because inventory is what, and its cost is what. This is a composition of quantity which is getting consumed, and the rate which is involved in respect of that quantity. So once both these aspects are taken care of, whether it comes to the measurement, or whether it comes to the procurement, or whether it comes to the consumption, then of course the final outcome which the auditor will derive in terms of its conclusions will be more appropriate. Yeah. So these are again some of the areas which are really required to be focused upon by the auditor. And as we discussed, that this GP margin analysis again becomes very, very important, because the way we really look at the P&L today, so we are not looking at the trading and P&L, which used to happen earlier, but definitely this GP margin analysis is very, very important. Yeah, because this is a reflector of how the production process is changing or how the production activities are changing. Again, a key activity for the manufacturing company. And all of these aspects are again very, very important for the management also to look at. Moving further, now, particularly from the manufacturing aspect, some of the items which are again focused upon from the audit side happens to be the items of PPE, or you can say the capex. Because if we talk about the manufacturing company, generally we will find that those companies are having a decent capex. Okay, so when we talk about the capex, so we are talking about the property, plant, and equipment, means we are talking about either the fixed assets or the capital work in progress. Okay, now capital work in progress is once again one area which is required to be looked at with sincerity by the management as well as by the auditor. So now what do you mean by this sincerity and what is really required to be looked at? See, generally what will happen is that when we'll review the capital work in progress, so what are the procedures that we perform? We'll check as to what all costs are going into capital work in progress. Are those costs of capital in nature? If that is the case, we are okay with this. But let's think of a company which is having, say, 5 projects. Okay, all the projects are going on, which are not really ready, means those are not really capitalized, those are not reached to the final stage, and they are into CWIP stage. So the first project was there, which is kept into CWIP, which was started by the company 2 years back. After that, what happened? Company dropped that project, or you can say instead of dropped, company kept that project on hold, and the company started project number 2, which is again into CWIP. After that, company moved to project 3. So second project is also on hold, and now the company is working on capital work in progress number 3. And same way things are moving on and on. So every time as an auditor, when we talk to the management, what will happen? They will say that project number 5 has become the priority, but of course all the previous projects are important for the management and they may be revived or they may be activated at any point of time. Now in this case, it becomes important for the management to do an analysis of the projects which have been kept on hold, that are they really viable? If those are really viable, they should be kept on hold or they should be continued as capital work in progress. Because if those are not really viable, then what does it indicate? It's a sort of impairment indicator. Okay, and this impairment may have to be brought in respect of some of those projects. And this CWIP, which is though appearing in the financial statement, should not really be there. Why? Because this is not going to get capitalized, or even if that get capitalized, that may not be financially viable. So some of these aspects are required to be looked at. And if you look at the reporting requirements now, wherein we look at the criteria which is followed under the financial statements, wherein this CV paging is required to be provided. Auditor is also required to be focused upon this. All of these are consequences of such of these items. Okay. The other aspect is about the fair valuation. Now, today, when we talk about the financial statements, particularly under Ind AS, at almost every other place we use this term fair valuation, but we are just limiting ourselves to the fair valuation aspect in respect of property, plant, and equipment, if at all that is chosen by the management, though this is generally not found to be significantly done by the management. But if at all that is done by the management, again it happens to be an estimate. Okay, and the moment we say it's an estimate, some sort of assumptions are involved, approximation is involved. So this has to be done thoroughly by the management, and again a focus of auditor has to be there in respect of review. And once again, we may have the involvement of both the management expert as well as the auditor's expert. And then comes one more important point, and which is again very, very relevant from the perspective of the manufacturing sector, that is about the major overhaul or the major repairs. See, unlike, again, I would say, like the previous practices, because once again, if we talk about accounting standard and Ind AS, both of them are aligned on this. Earlier, whenever there was any overhaul or any repair work, that used to get reported in the P&L, means that used to get charged off. But now, with the requirements of the accounting standard and with the principle of componentization which is there, the overall which is there, and if that is required to be carried out at regular intervals, and if those intervals are are going to occur, say, after every 1 year, okay, so what will happen? This will also meet the criteria of a PPE. Why? Because what does that definition of PPE say? PPE is fixed assets. Huh? PPE says that an asset which is expected to be used for more than one period. Now, overall, so let's think of a company which requires overall of its machineries, of its plant after every 3 years. So, what will happen? This overall cost will have to be capitalized. It's going to be appearing as a component in that particular part, and which is then amortized over the period of its occurrence, which could be 3 years, 4 years, 5 years. Unlike the previous practice, wherein we used to charge it as and when it arises. Okay, which again is going to create a significant impact on the financial statements. Why? Because by following this exercise, the volatility in the P&L goes down significantly. Yeah? That is really cut down. All right. So these are some of the aspects which were really required to be looked at by us, particularly I would say from the audit side more, because as we discussed that we were not really focusing more on the Ind AS or the accounting side. Now, I think with this we can just conclude our discussion, and happy to have your questions if any around this.
If you have any questions, then please write us in chat box. So should we wait for 2 or 3 minutes, right?
Yeah, sure.
Sir, one question: how our manufacturing industry will grow in future, despite of slowdown of economy?
I don't think I am an expert as around the business aspects of an industry. So I think it's more from the business side. Don't have much to say as far as the accounting or auditing aspect is concerned. More for the management to look at or the business owners to look at.
Yeah, sir, right. Okay, we are waiting. We are waiting. If you have any query, then please write us. Then I think all queries have been resolved.
Sure,
We
sure.
are not.
So thanks everyone for your time, and thanks Abhilasha ji for your time. Thanks so much.
Thank you so much, sir, for giving your precious time. So we have our next speaker, C. Arvind Taga, sir. Sir is a partner in Indian firm and last 24 years of experience serving Indian and multinational clients in field of assurance, Ind AS, IFRS, US GAAP and Indian GAAP. He has conducted various training sessions under various GAP for Indian clients spanning different industries, both national and international clients. He also participates in study groups of ASB of ICAI. Sir, I request you to please light up the session by your profound knowledge. Please, sir.
Thank you, Abhilasha. I hope I'm audible.
Yes, sir, you are audible.
Yeah. So first of all, good afternoon, everyone, and thanks for giving us this opportunity in which we can always get back to our community, our friends, and our colleagues in the profession, where we could share our knowledge, and as well as I think I look at these sessions to probably also gain knowledge from the other colleagues. So thanks for this session, and thanks for ICA for organizing such sessions for the benefit of members. So with that, probably the session which I have, uh, you know, impact of Ind AS in the manufacturing industry. I think the gentleman before me, he probably explained, Achal explained quite a lot of concepts. You might see a bit of overlap also in terms of those concepts getting reiterated now. But I would try my best to probably give. Ind AS is a vast subject, as one would say, many standards, many disclosure requirements, trying to subsume within a small period of time will obviously not serve purpose. So I'm sure there would be some questions, some requirements. I'll try my best to probably capture all of those major items as I can, which I believe impact the manufacturing industry. I'm sure there would be more as manufacturing industry evolves. As I would say, this becomes quite relevant for us from a country perspective. India is on the cusp of a big manufacturing boom after a long period of time. And I'm sure that also keeps us on toes. There was always this discount which was given to Indian companies just because sometimes the large companies were not speaking the global language. India took that probably, to probably allay those apprehensions, and India said, okay, we'll adopt IFRS. As I always say, gap remains, whatever is a gap which you do, cash flows remain the same. So, till the time as professionals, we are able to probably manage the cash flows well, the financials would always look out. But having said that, now that we are able to also speak the global language, and I think we are a dominant force in the global force now, I think if you see across the country, the way we understand and interpret gap, whether it is IFRS, Ind AS, or other gap, I think we stand out very, very clearly as Indians. And I think that's a proud moment. And that is primarily on the back of that the Institute facilitated along with the various regulators to ensure that Ind AS comes into us. It allowed us to probably get us into the mainstream of the global, accounting world. And today, I think we are leading the global accounting world. You probably take the large companies wherever we are. I think in the larger companies in a finance department, you will always find an Indian chartered accountant. And I think that's a matter of pride for us. And we should probably bask in that glory. But at the same time, I think the responsibility is cast upon us to probably carry that legacy and make it much, much more larger for the coming generation, which is there, and make it much, much more larger for them. So with that context, I think I will just set, and I wanted to set this global context because many a times we actually, belittle the significance of why we adopted this global standard. It was not to do that. It is basically to assimilate us into the global world and speak the same language. And as you can see, the valuations of our companies are now probably in the top bracket just because we are also speaking the same language. And as I said, it is just that people wanted to look at lens which is different for us. Our cash flows remain same, our economies remain strong. We are much, much more healthier in terms of the facts which are there. But now that we speak the global language, people are able to probably understand that language. We enabled that with this India's framework for us. So I think with that background, let me probably give you a quick overview in terms of what are the India's impacts on the manufacturing sector. Is my screen visible? Hello.
Yes, sir, it's visible.
Okay, you're able to see the slides, right? So,
Sir, no.
are you able to see the slides?
Sir, no.
Okay, just give me a minute, please.
Manish ji,
Sir, yes,
Are
now
you
it's visible.
you're able to see it? Okay, thank
Yes, sir,
you.
yes, sir.
Thank you. So I think what I want to quickly cover is, Ind AS, the various standards which I believe are more important for the manufacturing sector. These are the six standards which I believe are more critical, starting from presentation, inventories, which is, I think there was a detailed session just before the esteemed speaker before me gave lots of facts, but I'll probably delve more on the accounting side rather than in terms of how the measurement is done. Provisions, contingent liabilities, and contingent assets, that's also quite important. PP&E, which is basically the bedrock of any manufacturing industry. Leases, financial instruments, I think these are the more critical ones. I know there could have been a temptation to include a revenue recognition standard, but I've just probably not taken in this session because there could be many facets in terms of revenue recognition for lots of the manufacturing sector. So I'm just probably keeping myself focused on these contents. Yeah. So, important thing that today, and I don't want to reiterate, is Ind AS is applicable to all listed companies in India, apart from banking and insurance companies. They have to do any subsidiary, JV, and associate of such companies also have to prepare Ind AS at a standalone level. Uh, any company which is, say, not listed or neither subsidiary, JV, or associate, but having net worth of more than 250 crores, then Ind AS is applicable. There's a separate carve out for NBFCs, for which obviously, in a phased manner, you also have NBFCs listed. So there is a strong universe of companies which are there, and Ind AS is now there since March 15 in that sense, and people are available. So there are financial statements available of large companies available to us. So general purpose financial statements, as one would say, financial statements which could be used generally by people, whether by the shareholders to start with, then maybe the bankers of the company to start with, or any other stakeholder. And then if it's a listed company, then the listed shareholders or other, investors which are there. That's what is general purpose. Now there is a new term which comes in, which is called as total comprehensive income. There is this notion which is there with many people that Ind AS is all about fair value, and I want to probably break that notion very clearly. Fair value is always to a greater extent an option in Ind AS and not a compulsion. Only in certain circumstances fair value is a compulsion, where your intention is, say, for certain financial instruments which you want to trade, they have to be fair value, or because of certain instruments which have a nature that it could fluctuate with the prices at fair value. So fair value is many a case not a fait accompli answer. It's probably an option and not is there. And with that concept, there is now a concept of other comprehensive income, because there are certain movements within the balance sheet which you don't want to probably take it as part of your profit and loss, but you would like to probably reflect the net worth correctly, and hence those movements are captured in reserves. And that movement which is captured in reserves of the balance sheet is taken into maybe say an equity item or a reserve item called as other comprehensive income. And that is the new concept, that what is the movement in the balance sheet which is arising from your net income movement as well as the movement in your reserves. The combined impact of it is called as total comprehensive income, and hence it says total comprehensive income comprises all components of profit and loss and of other comprehensive income. Yeah. In terms of your key principles, as I said, the most important is to ensure that there has to be a fair presentation and compliance with all Ind ASs without any exception. And I think this is also whether I do an Indian gap, that's the same requirement. Uh, Offsetting and comparative information, India always follows a corresponding period approach. So whatever information is generally presented in financial statements in India always generally have a comparative. So that's why there is a detailed guidance in terms of whenever you present your financials from a corresponding period, what is the comparative information given. There are specific rules given in terms of in what situations you could offset a financial asset or a liability or other items. There is more detailed guidance available. Materiality and aggregation, I think, as probably auditors and probably as CFOs on the other side or other ones, but anything and everything which you do, There is a cost benefit analysis which you have to do. So there is a concept of materiality and aggregation. What is material enough? What could be aggregated together? So suppose a concept of aggregation which is there in segment reporting is critical. Materiality in terms of disclosures, what could be disclosed on the balance sheet or by way of a note, materiality becomes a larger issue. Presentation consistency, anything which is presented has to be consistent enough from an year and year so as to make any comparison, meaningful. I think that's again one of the levers or values which is there in any financial statements which continues with Ind AS. Accrual basis of accounting, I don't think so I need to delve more onto it. I think we by now understand accrual, though there is a cash component in the economy, but majorly of it is now moved to accrual basis of accounting. Going concern, and I think this is quite critical. There is lots of literature now being available from a going concern, and it has evolved over a period of time. So any financial statements, you are supposed to make an assertion if you're not preparing on going concern basis. Otherwise, it's always assumed that the financials are prepared on a going concern basis. So these principles are the bedrock of in terms of how indices or standards have been made. Components of financial statements, the difference between say Indian GAAP and Ind AS, if you see, one is the name is statement of financial position, which we call as balance sheet. Statement of P&L and other comprehensive income. We always have a profit and loss statement. Now we have an additional component of other comprehensive income. Then what we call as reserves and surplus or a movement which is given in schedule. Now there's a specific statement required by giving a statement of changes in equity. It's a specific statement. It's a primary financial statement. Statement of cash flows, which is continues to be in Indian GAAP, and the notes which you give. So what is the new thing is the bullet number 2 and 3, that now profit and loss also includes other comprehensive income, and there is a new statement which is statement of changes in equity. Yeah. From a statement of financial position, I think there is an expectation that you have to present your current and non-current items separately and definitely in order of liquidity. So I think that's a very, very strong requirement under Ind AS. And even if you look at, say, the Schedule 3, which is there as part of Companies Act as relevant to Ind AS, the Schedule 3, which is there, that's the way the disclosures have been given in Schedule 3. And then there is a detailed guidance note by the Institute on this in terms of how do we go about it. The current assets and current liabilities. So you have to make a distinction what is current and non-current on the face of the balance sheet, and that's where it is. What it says is current assets, the definitions remain the same, they are not different. Anything which is expected to realize in the normal operating cycle, typically an operating cycle is assumed to be 12 months, unless and until there is an option available that you justify more than 12 months, then it's a different issue. Then the definitions of current assets and current liabilities also accordingly change. Anything which is held primarily for trading expected to be realized within 12 months, and cash obviously is current because that's cash in hand. Any other assets, they will definitely be classified as say non-current, whether like it's a property, plant and equipment, intangible assets, or any other item. Maybe an investment can also get classified as non-current, depend on the intent and the requirements. Liability, again, more or less the same, nothing new about it. You know, but the most important point is the fourth bullet, which says you don't have an unconditional right to defer settlement of the liability for at least 12 months. So I think the word uses unconditional right. It doesn't matter in terms of what could be the likely outflow, but the important part is unconditional right. And I think that's what you should probably focus upon. Critical judgments and management estimates. This has now undergone also a significant change that now material accounting policies have to be given over and above these critical judgments. In an Ind AS financial statement, you will always find a specific note about critical judgments and management estimates. And what could be those, especially for a manufacturing sector? It could be useful life of fixed assets. It could be inventory obsolescence. It could be, say, employee benefit obligations, right? These could be quite critical estimates in terms of the numbers which are there, in terms of how do we come about it. Some of the other aspects could be, say, fair value of financial instruments, impairment of trade receivables, or say contingency depending on a specific industry which you are looking on. Say, suppose if there is a telecom industry and there is a huge litigation going on, that might become a critical judgment or estimate. Or any other manufacturing industry, some large case which is going on, which is specific to the industry or specific to the particular entity, you might probably show that as a critical judgment or management estimate. But I think my experience probably shows that the larger critical judgment is always useful life for fixed assets, especially in a manufacturing industry, and inventory obsolescence. You need to be mindful of it and then probably take care of that. Yeah. So that was in terms of an overall presentation of financial statements. If I go and probably pick up the pace, let's go to inventories. I think the standards, or probably more or less, this is in line with our own accounting standard of inventories under Indian GAAP, not much. Anything which is held for sale in the ordinary course of business is finished goods. Anything which is in the process of production for such sale, depending upon the nature or the stage of completion, it could be either raw material or work in progress. If it's just available in the raw state, obviously it's raw material. If there is some process and it's part of a process, then it could be work in progress. So that's the way probably you'll have to look into it. Anything which is support supplies which are there, which helps you in the production process or in the services, as the standard says. Any stores and spares or consumables which you will have. Typically every manufacturing industry, there is a huge storeroom. There will be lots of stores and spares which are available to ensure that the factories keep running in, and they take care of it, and they could become significant in terms of your overall inventory also. uh, Ind AS 2, which is the standard, it says what are the elements which could be captured in the cost when you recognize inventory as an asset, what could be carried forward till the time it kind of gets into the revenue cycle, and when the probably the good is sold. uh, Obviously, there are specific standards, and hence certain, like you would have seen in Indian GAAP, you also see a stock in trade for investments. Many a times there is trading, but that's being covered separately. In India, there's a financial instruments. Any commodity broker traders, I think they want to probably keep it separate. So they have specifically carved it out from the standard. Any biological assets is being kept out because there's a separate index for it, index 41. And similarly, any agricultural produce after harvest, because there's a specific standard under Ind AS 41, is being carved out from the original standard of inventory. So I think measurement of inventories, the principle remains that any inventory should initially be measured at cost and then subsequently measured at cost, lower of cost, and NRV. The concept remains the same. It's not anything different from the Indian standard. It remains the same. So what gets included in the cost is cost of purchase, cost of conversion, and other cost. Again, the concepts remain the same, nothing new, which are incurred in bringing the inventories to the present location and condition. So, from a gap perspective, this remains the same. There is nothing different from a Indian gap in this. Whatever is your relevant cost of purchase, any cost which is towards conversion or the normal cost of conversion, abnormal cost of conversion are not included, and any directly attributable costs which are important to bring the inventory to the present location and condition. That is included as part of the cost of the inventory. From an NRV, again, NRV is nothing but what is your estimated selling price minus the estimated cost of completion if it is still, say, suppose in work in progress, or any estimated cost if it's already finished good necessary to make the sale. That's what is, again, the definition remains the same. Situations where your net realizable value could be less is uh, your selling cost have significantly increased, or there is a huge fall in the selling price. The inventory gets obsolete, or there is a physical deterioration of the inventory. uh, and maybe there is a particular decision that just to capture market share, if you want to probably sell it at a loss, that could be one of the reasons. Or any errors in production or purchasing, because of errors significant cost has been incurred, which leads to abnormal increase in cost, that could lead to probably a lower NRV or something like that. Excuse me. I think the biggest item which is there is write down of inventory to net realizable value. That is generally done on an individual item basis, and this is very, very critical. Many times people look at portfolio of inventories. It doesn't probably go that way. Inventory, the fact that we do a physical verification of inventory, that means every item is counted for. There's a specific mention in Caro about how physical verification is done. There could be a because of large stock of inventory, you might do it over a period of time or a phase period of time, but the attempt is always to do it. Each and every individual item is basically taken care of, and that's the reason. any write down of inventory to NRV is normally done on individual item basis. There could be cases where you could probably draw an analogy and do it to portfolio, but typically the expectation of the standard is to do it on an individual item basis. Now, while you arrive at cost, you everyone is aware of in our old costing days, there used to be lots of methods and techniques in terms of how do we come to the cost. The standard probably says that there are different mechanics which one can probably use. But typically, what we have seen in the market is that items of inventories that are normally interchangeable, we do say FIFO or a weighted average cost method, you would do that. But there are specific industries, say like a jewelry industry or something, where you do a specific identification cost method. So it all depends primarily in terms of what options do you choose. But typically, FIFO or weighted average cost method is being done. Very, very critical. It says for all inventory of similar nature in use, the you should apply the same cost formula. So for a same piece of good or material, you can't have a FIFO for one item and say other item per se. It has to be one consistent formula which you follow. And the last but not the least, use of LIFO is prohibited. It is very clear that LIFO as an option is not allowed to be used at all. Yeah. So when do you recognize an inventory or recognize it an expense? Obviously, when an inventory is sold at that point of time, it takes the color of cost of goods sold. Obviously, when a revenue is recognized at that point of time, you'll also recognize the relevant cost of goods sold. If there is no future economic value, if there is an obsolescence or a physical deterioration, you are going to probably de-recognize that inventory. Many a times the inventory that you use, if you are using, say if you are a cement company and if you are using that same cement to carry out your or to probably construct your own factory building and stuff like that, at that point of time you might de-recognize that inventory and probably include it in the cost of construction of the other asset and recognize it that part. So depending on what is the nature or the event which happens, either when you have sold or if there is no future economic value or either of them, then there is either a de-recognition of inventory or recognition as an expense. So that was a quick overview in terms of say inventories. When it comes to Ind AS 37, I think more detailed guidance as also as compared to our own standard, which is AS 29, which is on Indian GAAP, and I think that's what is more relevant over here. The definitions remain the same. Again, provision is something where you make a provision for which you are not so sure, you are uncertain about the timing or the amount, and hence it is called a provision. And a liability is nothing but it's an obligation, and you know that there is going to be an expected outflow which is going to happen basis the past events which have occurred. So that's the definition part of it from a provision and a liability perspective. In terms of provision versus liability, very clear. The difference between them is liabilities are present obligations from past event which will likely result in an outflow of resources. The difference between liability and a provision is that in a provision there is an uncertain timing or an uncertain amount, and hence it's called a provision, whereas accruals would be that maybe you have received the goods, you are determined, the invoices have come later, and hence you know it, and that's why that gets the color of a liability as compared to a provision. So the only difference between a liability and provision is that if there is an uncertain timing or an uncertain amount, it is typically labeled as a provision. And the other way where you are sure that this is the stated outflow, but just because the invoice has not been received, so you show it as trade payables, just as an example, or maybe say employee payables for that matter, where you are sure, but you have probably paid in later. As compared to a provision, provisions could be items like provision for gratuity, provision for say employee obligations, or any other provision, for any other matter which is there. So again, when is a provision recognized? And many a times people forget the fact that a provision is recognized when all the following conditions are met, which is there is a present obligation, and mind you, the word is legal or constructive. If you have always given as a past, though there is no legal obligation, that also gets covered when you probably make a provision. So present obligation as a result of a past event, very probable that an outflow of resources would go out of the entity, and a reliable estimate can be made of the amount of the obligation. Only when all of these three conditions are met, you make a provision, not otherwise. And by any reason, if any of the three conditions are not met, there might be a need to give a disclosure dependent on the materiality of that. Yeah. And that is where the concept of contingent liability comes in, which says possible obligation. That means you're not so sure a case is going on, or probably there is a discussion going on where there could be a particular interpretation where you're not sure. An old excise case, probably an old GST case, or an old tax case which is going on, but you're not probably sure of the outcome. At times there could be a possible obligation because of the past event, and you could only get probably a confirmation post the settlement of those cases. Then more likely than not, you will a contingent liability would end up getting disclosed. Now, the disclosure for a contingent liability is only and only, right, if the possibility of outflow is not remote. That means you believe there is a decent enough chance of this contingent liability getting probably crystallized at some point of time, but because the outcome is not known, only then you disclose it. If you are able to demonstrate that this contingent liability is very remote, as of now, then you don't end up disclosing all of that. So you have to be very careful when you make this assessment. Is the contingent liability is there, whether it is going to be a remote possibility of that occurring or otherwise. And I think that's something which one needs to probably be very mindful about. Yeah. Contingent asset, no double thoughts about it. There could be a contingent asset. You might be sitting on a big refund, but you are not so sure. You might be probably sitting on a big benefit which might come in, but it is pending probably an outcome of a court case. Now, in that case, you are required to disclose the description wherever you could make an estimate, right? But you should not, and you are not allowed to recognize a contingent asset till the time you are virtually certain that you are going to get it. Even for an example, for a matter, if I have an insurance claim receivable, if you are not sure of that insurance claim, or there is no certainty about it, you recognizing it, then you don't recognize that an asset. You only recognize, say, when the claim is accepted, or just probably the inflow of that claim is there, just as an example. So you have to be very careful in terms of a contingent asset. You cannot recognize a contingent asset at all. Yeah, you could disclose it depending on the availability of data or information to the entity concerned. So provision, a best estimate of the expenditure which you can believe you have to make, a provision is to be done. Many a times you require experts to probably give you that best estimate. So, it just says that there are various options. You probably look at various evidence which are available for the events which have occurred after the balance sheet date. Um, Say, suppose if there was a case which was going on for a particular provision, but now there is more clarity given in terms of how the computation should be done, say by the department, then you could probably take that evidence and make that provision basis that clarification, because you've got more information available. There could be different techniques. You could probably either say that this is the most likely outcome, or you could probably take various options or the probability to say what could be the likely outflow. There could be a 50% outflow of an X amount, there could be 30% outflow of an X amount, there could be 20% probability of an X amount. Then you take a weighted average of it and comes to the expected value. So there is nothing hard coded. It always gives you various options and abilities to there to make the best estimate of the provision, because at the end of the day it's a provision and not a crystallized liability, and that's why there is more flexibility given. As they say, a provision is always measured before tax. An advantage which you get for tax is for a provision, if suppose the deduction will only happen on actual crystallization, you might create a deferred tax for it, but the provision has to be of a gross amount in your financial statement. And not the least to say, any provisions which you probably make, you always need to reassess them basis the current estimates or the current judgments at the end of each reporting period, to say if there is any change for increasing or decreasing those provisions basis the new estimates or the new information available to you. I think that's anyway being given as part of the standard. Now coming to the larger one, which is property, plant and equipment, and I think this is going to be the most critical for our manufacturing sector. PP&E as the new name, which is known to all of us now, anything which you believe are held for use in the production or supply or goods of services over a long period of time. And the second bullet is more important and are expected to be used during more than one period. Typically, the expectation that anything which is going to be within 1 year, you will expense it out and not show it as an asset. But anything which you expect to be using more than your normal operating cycle, you would probably end up showing that as a PP depending upon the nature of that item. Carrying amount is the amount at which an asset is recognized after any accumulated depreciation and impairment losses, if any. Depreciable amount is very critical, where people always understand the cost part of it, but they forget the last part, which is the residual value. It is lets its residual value. So you need to depreciate an asset up to its residual value, and the residual value should probably appear in the financial statements at the end of the useful life of that particular asset. But many a times you have seen that people forget the concept of a residual value. So residual value is again a critical estimate or a judgment point in quite a large amount of manufacturing industries, right? Useful life, the period over which it's expected to be available, or maybe whatever are the benefits you are going to get. So useful life is again a concept which is very, very important, because any asset or any PP&E which you do is to be depreciated over its useful life. Yeah. So useful life and residual value many a times are quite critical in terms of the depreciation, which you probably pass it through your income statement or P&L, or maybe add it to the cost of inventory if it has been used in the process of producing inventory for the entity. So recognition criteria, you should be sure in terms of what is the amount which you are doing at a period of time. There was a detailed discussion on capital work in progress in the earlier session, so I'll probably not take that much time in terms of explaining the concept. The cost of the item should be measured reliably. It should be probable that you will get future economic benefits out of it. And what could be that those cost items is, in case of purchase, obviously the actual amount of the purchase. Many a times you might buy it at foreign currency and that amount might fluctuate. So the day probably when you recognize that liability, it should be at that spot rate. And then there is separate discussion in terms of any foreign exchange fluctuation in terms of how much of that amount could be added to the cost of asset or not. In case of self-constructed assets, again, whatever is the purchase price of the material which is there, but it also includes the cost of labor or the cost of converting that particular self-constructed asset into an asset for your own use. So you need to be mindful of it. Sometimes you'll require, say, suppose if you are paying your own workers to create a particular asset within your factory, you need to probably, if you have to allocate the salary of those particular workers who are constructing that particular asset, there should be enough time logs available to justify that this is the time spent for particular construction of that particular asset, and that would be very helpful from an overall audit angle to justify that this is the actual cost incurred. Yeah. Any subsequent cost, day-to-day servicing, obviously it has to be recognized in the P&L. So any normal genuine store spare parts, any nuts and bolts in the normal scenario would be charged to your P&L. However, people probably, the two items which are there, the cost of replacement, the requirement that when you replace a part, many a times people forget it, that when you replace a part and if it's a significant item, you need to decapitalize the old part, right? You de-recognize it, recognize the necessary gain or loss in terms of disposal of that particular, and you recognize a new part and probably capitalize it and depreciate over the remaining useful life. This is very, very critical whenever there is a replacement in a large machinery or everything. Many times people kind of forget this part, and you end up saying that you don't re-recognize the old part, you add up into the cost of replacement of the new part, and you do depreciate over the remaining useful life, but you always forget that you need to de-recognize the old part also. Any major inspection or overhauls, again, what it says is any major inspection cost. So typically, say suppose if you would have uh, a boiler or a furnace, which requires relining, say after a particular amount of years, but it gives you, probably an advantage for the remaining 5 6 years depending upon the nature or the tenor, and that cost which you do is quite significant, then what you do is you capitalize that cost and remain and depreciate over the remaining useful life or the period for which the benefit is going to come. But yeah, if you kind of, again, the concept remains that if you are going to de-recognize any portion of it while doing refurbishing and everything, then that cost has to be de-recognized uh, from the inspection and then taken care of. Yeah. So cost of replacement and major inspection overalls, I've seen lots of discussions happening on this portion per se. Yeah. Again, I think cost what includes is purchase price, including any duties which you have to pay, any non-refundable purchase taxes, any discounts, less any discounts or rebates which you have, that's included as part of the cost. Any direct attributable cost of bringing the asset. So if you are importing something and if there is a significant freight cost which is incurred to bring that particular machine item, say from whichever factory side or from a port or any other location to the factory side, then those costs are also allowed to be capitalized. Any initial estimate, and this is the portion which I've seen many a time people forget, any estimate of the unavoidable cost of dismantling. So tomorrow, if you are installing a machinery in a lease premises, and there is a requirement that after the lease premises get over, you are supposed to give them a clean premises at all. Many a times that cost is probably forgotten, uh, or probably removal of that cost, which we typically are knowing as asset retirement cost. That cost has to be capitalized also. So very, very important that the last, the one which is on the right hand side, the last block which is there, unavoidable cost of dismantling and removing the asset and restoring the site on which it is located. The present value of that cost has to be capitalized. And obviously, you will recognize a provision for ARO or an asset retirement obligation against that, but you need to probably include that cost in the initial estimate. Any cost which are on account of capitalized foreign exchange differences, to the extent we believe that they are an adjustment to interest cost, you need to probably include that as part of the cost of the asset. Any direct attributable cost you can capitalize, till the time, again, a generic item, but in practical terms, now there is new guidance coming in terms of any pre-operative cost, what could be capitalized and what could go through P&L. So you have to be very careful. Many a times I've seen in the past that people include anything and everything under the sun in the nature of pre-operative cost and include it in the overall plant and machinery. That is now going to get scrutinized very, very strongly going forward. So you need to be very careful about those direct attributable cost also. Now, interestingly, there are two models available in terms of valuing a property, plant, and equipment, which is a cost model and a revaluation model, right? Which is allowed in terms of how do you do it. But I'll take those models separately. But in case if there are decommissioning costs, how do you deal with it? That's very, very critical. Decommissioning cost, as I said, is any asset retirement cost or anything else. So suppose tomorrow, if there is a nuclear reactor, you are doing a nuclear power, or if you are into a power industry and you need to probably clean that particular area, or maybe you are into an industry which is probably, say, making metals and you need to clean that area. All could be, significant decommissioning obligations which are there, which says any changes in the estimate of decommissioning obligations, if you are following the cost model, you will probably add or deduct from the cost of the related asset. In case of a revaluation model, obviously, because you are recognizing the revaluation surplus as part of other comprehensive income, you will probably recognize that change in other comprehensive income. Very, very critical. Any deduction that would give rise to a negative asset, obviously, you can't have an asset which is negative that gets recognized in the income statement immediately. uh, if it increases the carrying amount, obviously, the test of impairment, which at a minimum is supposed to be done on an annual basis, depending on the triggers for impairment, you need to deal with it. And any adjusted amount which is there of the depreciable amount will be depreciated over the remaining useful life. Last but not the least, which again people forget, is that any decommissioning obligation is always at present value. So when you unwind the present value in the provision, right, over a period of time, the cost which you incur gets treated as a finance cost. So any unwinding of the discount on the decommissioning obligation on the liability side gets recognized to the income statement as a finance cost. So that's quite critical, which you probably need to factor in terms of your overall decommissioning cost. So as I said, measurement after initial recognition, any model for recognition you have to do on a class of asset level. That's very, very important that you define a particular asset class, and for that asset class you follow the relevant model. You can't have a pick and choose in that sense. The asset class has to be determined. There is one model which says cost model, which we generally know, cost less any depreciation, less any accumulated impairment loss. There is also an option to do it at a revaluation model. The standard allows you to do that. That again, it says that you have to fair value on every date of reporting to say what is the revaluation. And basis that revalued amount, the depreciation would get charged year on year basis that revalued amount, and that gets straight to the P&L. The option of saying earlier that you could probably use the additional depreciation and adjust it against the revaluation surplus which used to be there in the heydays, that option is not available at all in India. So in a revaluation model, if you increase and you want to follow that model, then that additional depreciation will also hit your P&L, or vice versa in case if there is an impairment, right? Very critical. Revaluation can be done provided have a you could have a valuation which is quite reliable and taken from the right sources in that sense. Yeah. Again, this depreciation which you charge, depreciation should be a systematic allocation, and many a times people kind of get confused over a systematic allocation, what it is. Depending upon the nature of assets, the systematic allocation is there, but there is more or less a default option that you would end up doing it on a straight line basis, typically over a period of time. WDV as an option is very difficult to justify, though there's available in income tax, you can do that. But many times, depending on the nature of the asset, you end up doing it on a straight line basis, and there is enough guidance available in the standard to probably say in which cases, which methods you use. Again, depreciable amount should be allocated on a systematic basis. Componentization, again, a concept which is there in the old Indian GAAP, also continues in India. Each component has to be treated separately. If you believe within a useful life of say 20 years of an asset, there are components which gets replaced within 7 years, 8 years, then those significant components have to be depreciated separately. They need to get de-recognized when the new component again gets added during the overall useful life. Land and buildings, they are treated as separate assets for depreciation purposes. Land, obviously, you cannot, you know, any quarries or landfill sites which are there, you could probably depreciate such land, but not otherwise. Otherwise, land is always supposed to have an unlimited useful life, and it is not depreciated at all. Uh, in terms of useful life, the option is either a period over which the asset is expected to be used, or any units basis which is there, or units of production method as they call it. You could do it on that basis. Residual value, very critical. We discussed that. And methods of depreciation, very critical that the depreciation method which you do should reflect probably the pattern in which you could depreciate it. My understanding and expectation is that typically you end up doing it on a straight line basis, unless for a particular industry it could be justified in terms of a different systematic allocation. Yeah. From a derecognition of property, plant, and equipment, any derecognition which you do, very critical. Any gain on a sale is not classified as a revenue. Any gain or loss is nothing but the difference between whatever proceeds which you get depending upon the carrying value of the asset. They should be recognized as income or expense in P&L. Disposal of a revalued asset, very critical that when a revalued asset is disposed of, you have an option available. Either you leave that amount in the revaluation surplus, or you could transfer that amount from revaluation surplus directly to retained earnings. But that could be only a movement within the balance sheet and not through the P&L. Yeah. So very important aspects of that. So with that, I think I'll come to the new standard, and this is a standard which is different from the current Indian GAAP, which is on leases. And this standard is a big game changer for quite a lot of companies, that now there is no concept of an operating lease or a finance lease for a lessee. Any lease of an operating lease, barring certain exceptions which are given in the standard, now you have to show that as right of use asset on your balance sheet, and very, very important in that sense. So what it says, what the change is only primarily from a lessee's perspective. What it says now, earlier what you used to do, or rather what you do in AS 19, you have a finance lease and an operating lease. Typically, operating lease always comes as an expense on the lessee's book, that you do a lease expense on a straight lining basis. If it was a finance lease, you used to record an asset and a lease obligation and then have a depreciation and interest expense. Now, the entire finance lease concept is now embedded that any operating lease, barring those exceptions, have to be shown on the balance sheet as a right of use asset, and a corresponding lease liability has to be recognized. So today, if you are having any assets on lease, so suppose if you have taken any building on a lease, or any office premises or a factory premises on a lease, where you know that there is going to be a committed period of say 3 years, 4 years, 5 years, and you could identify that amount, the present value of that amount basis your incremental borrowing rate which is there, you discount it, you record a lease liability, and then you depreciate that asset. This is a significant amount of work which I think organizations need to do. Lease standard, though it's almost now 4 years, since it is already there in the standard, but I've seen this standard requires the maximum number of efforts, because it says any and every operating lease, barring those exceptions which I will take through, you now have to recognize an asset and a lease liability. That means your balance sheet is grossing up big time now on because of this new standard. Yeah. So this is a very, very critical change. What does it say? It gives you a definition of lease, very, very simple definition in that sense, but lots and lots of literature around it. Is there an identified asset? If the answer is yes, then the next question which you need to answer: do you have the right to obtain substantially all or majority of the benefits throughout the use of that particular uh, uh, use of that asset? If the answer is yes, do you have the ability or the right to direct how you could do and for what purpose you could do during that period? Then in that case, if it is primarily to a if you are a customer for it, then it contains a lease. If it is for a supplier, or if you are a supplier in that sense that it doesn't contain a lease, I mean, I think that's quite there. Because if the supplier has the right or substantive right to substitute an asset, it might be different, but it all depends. Say, suppose if you have a printing machine in your office, and that printing machine, you say that I am taking this printing machine on lease over a period of time. Now, whether the printing machine could be substituted, a new printing machine could be given to them, you need to justify whether it is a substantive right to substitute that asset or not. Depending on that, the answer would be there. So there are certain critical clauses in it in terms of when you go to this lease standard, and you probably need to be mindful of it. Again, as I said, these standard is there for the last 4 years. People I've seen in the market, people are probably uh, not been able to understand the nuances around it. They believe it's an operating lease, the old finance lease comes in. But this is a very, very significant activity many times. First of all, to get an inventory of all the operating leases in an organization, and then to do the calculation. Yeah. So obviously, as any standard, what are exempted? So any short-term lease, so any lease which you believe has a lease term of 12 months or less, but there are conditions to this, how you identify that 12 months or less. You, just because a lease period says that you could terminate the lease with 3 months period notice, doesn't make it 12 months. There are conditions around it, so making it very clear. Uh, it can be applied to a class of underlying assets. So if there is a particular class of assets, you could probably look at it. The lease should not contain any purchase option, right? Low value leases. Now, low value, it has not been defined in the standards per se that what is low value, but in the IFRS standard, there is some mention to say 5,000 odd dollars could be treated as a low value. Again, that's given as a suggestion, not as a bright line test. So you could define what is low value leases in terms of how do you probably deal with it. But that low value is to an individual asset. It is not a combined asset per se. Any asset which is of that particular low value, which you need to probably look into it. Yeah, very important that if you take the exemption, then obviously the lease payments, as you were to do a normal operating lease payment, they have to be done on a straight line basis, or any other term if you believe is a different option. But otherwise, that's the way you deal with it and nothing else. Yeah. So very, very critical terms, right of use asset. You have to recognize what you need to be very sure of what are the lease payments. Anything which is variable, which you're not sure, you are allowed to probably exempt it. But as and when the variability gets removed, you need to probably factor that in as part of the lease payments. Any restoration cost or any initial direct costs which are there for the lease. So tomorrow, if you have a leasehold improvements in a building thing, then you need to probably recognize those leasehold improvements separately, or any costs which have been incurred to probably get that lease. So tomorrow, if you are going to register that lease, there is a huge stamp duty which is being paid to register that lease. Then that duty also gets subsumed within the right of use assets. That's very critical. From a lease liability perspective, the most important part is knowing obviously the nature of payments and the discount rate. The discount rate, the standard says, is that whatever is the incremental borrowing rate which is there, and in case if you don't have borrowings, then you could simulate that if you were to go out into the market to take borrowings for the tenor of the lease, what is the rate at which you would get. That's very critical. And the last but not the least, lease term. There is some more information about lease term in the upcoming slide, but lease term is quite critical. If suppose there is a significant economic penalty for you to cancel the lease, then suppose if I have a lease which says that with 3 months notice period, the lessor or lessee can cancel it. But if you cancel it and there is a significant economic disincentive for the lessee to do so, then the lease term is considered, over the normal cancelable or non-cancelable period which is there. It includes probably it gets extended to that period. And many a times people probably forget the part of significant economic disincentive, because as the lessor, when somebody gives you anything on lease, they are there to probably get their normal financial return for a lease, right? That is why that particular asset has been given on lease to you. So you need to be mindful that if there is a significant economic disincentive to the lessor, if it has to terminate the lease, then the period needs to factor in, or the lease term needs to be factored in accordingly. Modification of a lease. So any modification which happens, in the terms or the original part of it, you need to probably see it. What is the modification? There could be different scenario. Either it decreases the scope of the lease, or it increases the scope of lease, or increases the lease consideration with the value. There could be many other items which are there, which comes in from a modification angle. But for all of these scenarios, the most important is, does the modification change the scope of the lease? If the answer is yes, it is reduced, then obviously you remeasure your liability and decrease the carrying amount of asset accordingly. If it's unchanged, right, nothing happens, the modification doesn't do, there are certain terms being changed, otherwise more or less everything remains the same, then you continue with whatever it is if there is no adjustment. But yes, if there is an increase in the amount of lease payments, you need to find out, are there more assets? Is the change in asset commensurate or anything? Or does it require that you need to do a separate lease contract or no? If there is no separate lease contract, because an asset is getting added, it is part of the overall asset, then you probably adjust it in the current valuation and don't do a separate right of use asset and an obligation. So modification, again, at least during the COVID times, modification was quite critical because people changed their lease terms subsequently. But now that's kind of settled. So, but still in future, if you are modifying the lease terms, you need to be careful of the implications of it on your financial statements. Yeah. Lessor, I think the accounting remains more or less the same. Probably I'll not spend more time from a lessor point of view over here, because that's more for, say, a finance lease perspective. But I think the requirements remain the same. If it's a finance lease, you do recognize that asset value, you recognize probably as a finance lease or a financial asset on your balance sheet. And if you are a lessor dealer in that sense, from a manufacturing perspective, then you probably recognize a profit or loss on selling that good and then recognize a finance lease. If it's an operating lease, I think the income gets recognized on a straight line basis. Yeah. Sub leases, very, very important. You might have taken an asset on lease, a particular building you have taken an asset on lease, and if you sublease it further to your group company, you need to be mindful of it in terms of how do you tackle it in your financial statement. So you'll have to de-recognize that portion which you give to your own group company on a sublease from your right of use assets, and then depending upon the nature of the term, you might end up having a finance lease for that sublease or otherwise. So very, very critical that any sublease classification which is there, you need to be very careful in terms of what is the implication. You might be the original lessee, but you might have sublet to someone else. Then in that case, whatever portion you have sublet, you get into the capacity of a lessor, but for the head lease, you remain as lessee. So the accounting obviously will probably change to that extent, and you need to be careful in terms of how the classification happens. Now, coming to probably the larger standard, which is on financial instruments, and I'm mindful of the time, so being cautious about it, and that's why probably going through a bit fast on my slides. But this is the most critical standard, vice versa. 109. So while we probably dealt more on the asset side of it, there is 109 where either surplus cash gets deployed by the manufacturing industry from a 109, or say for trade receivables which are there on the balance sheet, which also becomes a financial asset. Or on the liability side, which is Ind AS 32, which says that if you are funding your asset through either debt or equity, in terms of how that classification happens, very critical. 107 and 113. 107 is all about disclosures, and 113 is a fair value standard that when you do a fair valuation of any asset or a liability required by the standards, how do you go about that fair valuation? So these are the standards as I kind of mentioned earlier. Now coming into financial instrument, very clear. A financial instrument is any contract that gives rise to a financial asset of one entity and a liability or an equity instrument of another entity. So an investment which you have made in a company would be a financial asset for you, but for the other party, the investment could either be a liability. Say, suppose if it's an investment in NCD, then the NCD becomes a liability for the entity which issued, or if it's an investment in equity shares, it could be an equity for the entity which is issued, but it is still a financial asset for it. That is what the definition is. Financial asset for entity A could be a financial liability or an equity for entity B, right? Depending upon the nature. Now, what is the definition of an asset? No prizes for guessing. They have made it very clear that cash is a financial asset, so you don't have to, on a lighter note, break your heads onto it. So cash will be default financial asset. Any equity instrument of another entity is defined as a financial asset for you, but there are cases where you invest in a subsidiary where you probably show it as a non-financial asset, so there are exceptions to it. Very, very critical. A contractual right to receive cash or another financial asset from another entity, which is like a trade receivable, or to exchange any asset or financial liabilities with another entity under conditions that are potentially favorable to the entity. It could be a derivative, that if you are in the money for a derivative instrument, you might get some benefits out of it, otherwise because you are in the money. Very critical point of it, a contract that will or may be settled in the entity's own equity instrument, and it is a non-derivative for which the entity is or may be obliged to receive a variable number of the entity's own equity instrument. So this primarily, the standard is to say that in case if you have any kind of a derivative contract, you need to probably be focused upon it. But typically we don't see this coming in a real life scenario. There are very few cases which come in. So you need to be kind of, warrant could be one example which could be there, that you might be obliged to receive or vice versa. So the three bullets earlier are something which should focus upon. The other is generally not used in probably an overall parlance within India. Yeah. A liability would be if you have an obligation to deliver cash to anybody, and very, very critical, under conditions that are potentially unfavorable to the entity. So derivative liability could another example. You could have probably return, or probably you could own a derivative where you might end up paying to someone. Then it could be a derivative liability, which is a financial liability for you. Again, the same thing, a contract that will or may be settled in the entity's own equity instrument, and it's a non-derivative for which the entity. So if an entity, and I will delve this more when I take up Ind AS 32, but if you have issued an instrument, say suppose a compulsorily convertible preference shares hypothetically, but the number of shares which you issue would end up being dependent upon the fair value of the shares at that point of time. Now, because there is variability in the number of shares which would end up getting issued, it would become a financial liability on your balance sheet and not a equity. This is very, very critical. Any variability which is there either in the number of shares which you would end up issue in a convertible instrument or the price at which you issue, because of that variability, it would end up getting classified as a financial liability on your balance sheet. You need to be mindful of it in terms of how do you deal with it. Any derivative, obviously, as I said, would end up being a financial liability on your balance sheet. Right? Initial recognition. Any financial instrument has to be recognized at fair value at inception, which I think is very clear. There is no ambiguity about it. Typically, all the transactions are presumed to be at fair unless and until it's with the related party, and you need to be very sure about it. So financial assets and liabilities, you are generally recognized on the balance sheet only when you are a party to it. So you recognize an asset only when you believe it is there. So I might have bought an investment today in the market today, but for which, say, the settlement date is tomorrow. But because I'm contractually bound with it on a trade date basis, I would probably recognize it if I follow trade date basis and investment in my balance sheet today, or a vice versa situation. Yeah. From a classification on the asset side, for equity instruments, so they have basically bifurcated into equity instrument, debt instrument, trade receivables, and others. I will take equity instrument. Default option for an equity instrument is at fair value through P&L. Default option, I'm making it very clear. Unless and until it's an investment in a subsidiary, associate, or JV for which there is a separate standard available in Ind AS 27, which allows you to do it at cost. But otherwise, equity instruments in general will have to be taken at fair value through P&L, which means gains and losses to go through the P&L. Having said that, you have an option available to measure an equity instrument at fair value through OCI, if your intention is not to trade into it, which means you have an option to take the gain or loss in your reserves, but that option is irrevocable option, making it very clear. It's an irrevocable option. You don't have a choice at all in that. And because it's an irrevocable option, be mindful of it. Any gain or losses subsequently on sale of that particular asset will never get into your P&L at all. So tomorrow, if I recognize that fair value through OCI and I sell off that asset, the gain which I make on that asset particular will never come into the P&L. I can transfer it from OCI to say retained earnings directly in the reserves, but I can never route it through P&L. So that means any asset which is fair value through OCI equity instrument, it will never be part of your EPS or net income at all. Having said that, any dividend income will continue to be in the P&L, and there used to be erstwhile an exemption for unquoted equity instruments. It's removed. So even if you make an investment in unquoted equity instruments, you are required to probably show it at fair value through P&L or fair value through OCI, depending on the option chosen. Yeah. Debt instruments, there is a business model. There are three options available. It says what is the intent or what is the business model. If your business model is to hold the financial assets to contractual cash flows, if the answer is yes, then you need to meet the SPPI test. That means, does the particular instrument give you a return of your principal and a defined rate of interest for you? If the answer is yes, then you have to see whether you have chosen a fair value option to eliminate an accounting mismatch. If you have not chosen that option, then you can recognize it at amortized cost. And I'll take up what is amortized cost later on. So this is typically known as an held to maturity category or an HTM category or amortized cost category. Very, very important. It's a business model definition. You need to probably take care of the business model. If the intention is that you need to have a flexibility of both the business model and the other part of it, then you need to have the flexibility of either I sell the asset or I could determine to probably hold it even contractually. I'm not so sure. I need to be flexible. In those cases, again, you have to meet these criteria. Does that cash flows represent SPPI? Does it, have you probably not chosen a fair value option? If the answer that you have also not chosen a fair value option, then it goes through fair value through OCI. What it means, you will recognize the asset at the fair value and the gains and losses will be part of OCI. But there are different rules in terms of when you dispose of a fair value through OCI debt instrument, on disposal, the gain or loss does come to P&L as compared to equity where it never comes to P&L at all. Now, if your intention is neither to hold contractual cash flows, neither to be flexible, but only to trade, or you don't meet the SPPI test, then fair value through P&L is default. Again, if you choose the option of fair value option, then anyway it has to be fair value through P&L. You have no option. So debt instrument, this model is quite critical. So you have three measurement criteria: amortized cost, fair value through OCI, and fair value through P&L. These are the three criteria which you need to lead into, and you need to have this business model available within you to decide in terms of what classification, and then the subsequent measurement will follow. What is SPPI? What is an SPPI test? Say a normal debenture with a regular interest coupon, even for that matter, a treasury bill or a commercial paper will meet the SPPI test, because you will always get a defined amount of item over a period of time, even if a zero coupon bond with obviously a determined value which can qualify as an SPPI, provided there are no other options embedded or attached to it like a put or a call option. Then you need to analyze it separately for them. If there is an accounting mismatch, where both the asset and corresponding liability, so just take an example like a ULIP for an insurance company, right? If they've taken in ULIP, whatever is the movement in the value of the asset would also get passed on to the policy holder in terms of a liability. Then you might choose to fair value both the asset and liability in the P&L, so that life is easier for you. So that's as part of an accounting mismatch, an example which is there where you can probably follow. Now, compound instruments, this is another level which is there, which says you could have an elements of a debt or an equity in an instrument. So just to give, say, a compulsorily convertible debenture, where there is an element of debt because there could be coupon into it, there could be a conversion at a fixed price. Then you need to probably separate it into debt and equity if you wish to, and if you don't want to separate it, then you will have to value that particular instrument at fair value. So what it says is that a compound instrument is an instrument where you have to evaluate the terms of the instrument and determine whether it contains both a liability and equity component. Now, such components, they should be classified as financial liabilities or equity instrument depending on the nature. You could also have a situation where you could have a liability and a derivative instrument within a standard or within an instrument. So depending on the terms, the compound instrument, the requirements are quite clear over there. Yeah. Expected credit loss. Now, this is quite significant, at least from a trade receivables part of it, where it says that you always forecast, you don't wait for a provision to make basis a default which has happened. So you have no incurred loss method. You need to probably procrastinate for the future, and basis that you need to probably account for an expected credit loss. Now, I will not delve into more about, say, lifetime expected credit loss or 12 month on everything, but as a concept, what it says that if you have an asset today, irrespective of the fact whether that, say, trade receivable or anything has turned into bad debt or anything, but basis your history or future trends, if you believe there could be a potential that it could turn bad, then that provision has to be done on the day when the asset is recognized on your balance sheet. That is why the word expected credit loss is used and not the term incurred credit loss. So this is quite significant. Many times on your trade receivable side, basis on your aging profiling, those ECL losses have to be probably captured in quite critically. And you would have seen in my critical judgments and estimate, this is one of the items which I reflected, that you need to have a policy in terms of how do you provide for those credit losses. Yeah. Amortized cost, I think this is a concept which is known to us also in the past. In the leases, the concept of amortization was always there. It's being reflected here. So let's assume I had an instrument of 100 rupees face value with a coupon of 10%. There is a premium in the market because today rates are around 7.5%. Suppose there is a 2 rupees coupon, I will buy it at 102 rupees. That's the premium which I have paid. So the income which I recognize in my financials should be, so let's assume my YTM is say 7.2%, right? So I'll have a normal interest coupon of 10, but then I'll also amortize that 2 rupees of premium on an IRR basis or a YTM basis. and will reduce my interest income to that extent. So I'll pass an entry interest income to investment cost in that sense, and that is what is the amortized cost of that investment, and the interest income is amortized. Similarly, if there are any transaction costs, especially on the borrowing side of it, when you take borrowings, there are significant initial costs which are there. Those transaction costs are not to be recognized immediately in the P&L, but they have to be amortized over a period of time of the assets. Remember, there is no option to use straight line method. What the standard says, even if you want to do straight line, you need to be sure that the outcome which you get is not materially different from what you would have done if you were to do an amortization. So the option to straight line is not there. You still have to justify that if you are doing on straight line, the numbers would materially remain the same if you were to follow an EIR method or an IRR method or an YTM method, as we call it, right? Long-term or short-term borrowings, they need to be recognized over the term of the loan using the PIR instead of charging them to PNL. This is very, very important, which I said. Remember, any transaction cost under a financial asset, if it is at fair value, uh, any transaction cost which you incur, that has to be straight away taken to the P&L, because if your asset itself is valued at fair value, then the transaction cost can't be capitalized. That has to go straight away to your P&L. But yes, in case if you do it at amortized cost, as I explained, the transaction cost will be adjusted in the value of those assets, which you would probably recognize it, say, over a period of time. Critical, very, very critical disclosure requirements on 107. It says three elements of risk has to be necessarily given. One is the credit risk, the liquidity risk, and the market risk. So what is credit risk? Typically, say an investment which you hold, or the cash which you there, cash which is at bank, or anything, there is a credit risk that the counterparty might default or you may not get your money. Now that credit risk has to be shown very, very clearly. And if you would have seen the last year's amendments, now there is a requirement also in terms of credit profiling to be given as part of your balance sheet. So now your credit risk has to marry that profiling per se, to say how do you manage your credit risk, say on your trade receivables or on your investments, especially if they are on the bond side, or if cash which is available at banks, whether those banks are of sound quality or not, or everything, there has to be a mention. It could be a qualitative or a quantitative mention depending upon the judgment of the entity, but you need to disclose that. Liquidity risk is nothing that how much of financial assets, liabilities which you are to pay, are there enough financial assets to probably take care of it? So there are buckets. Remember, liquidity risk has to be given on an undiscounted basis. Repeating again, undiscounted basis, not on a discounted basis. Many times we recognize from a balance sheet perspective on a present value basis, but when you give a liquidity risk, it has to be given on an undiscounted basis. Market risk is to say how much are you prone if there is a significant borrowing for you because interest rates move up and down, uh, say 25 basis points up and down, is there a significant impact on your PNL? Foreign exchange currency risk, if the currency risk goes up and down, what is the risk? Or if there are investment in equity shares, because of the price volatility, what could be the change in your PNL because you have chosen fair value to PNL? So these are certain of the disclosures which you have to give. Again, as I said, they can be qualitative and quantitative. Sensitivity is given especially in terms of market risk. Say for a 25 basis movement in my interest rates, what could be the impact on my PNL? Or for a 5% plus or minus in the movement of say INR USD currency or INR euro, what could be the impact on my PNL? You need to give those disclosures. Obviously, what the management sees, it has to be through those eyes. How do you manage those risks? Or a risk management committee looks into it. I think those disclosures have to be given. And then there are certain minimum disclosure requirements given as specified in the standard which you have to give. So you need to give on your financial assets and liabilities the three pillars of credit risk, liquidity risk, and market risk. Now, if you thought everything was okay, any instruments which are measured at fair value, very clearly measured at fair value, right? So that means you recognize them at fair value. Then you need to give the fair value hierarchy. Now it is typically known as level 1, level 2, level 3. Now, what is level 1? Very simple. Any asset for which there is a quoted price available in an active market. So suppose there is an investment in equity shares which is actively traded in the market. You know that quoted price becomes level 1. Level 2 is, though it is not say actively traded, but say suppose you have made an investment in a company in a sector which is commonly known, say an FMCG or everything, it could be easily understood. Those are observable inputs to do it, then that could be, say, level 2 in that sense. Non-observable input is that you've invested in probably, say, a startup hypothetically, where you can't probably understand the particular nature of the startup. There are not enough inputs available for you. That becomes level 3. If during the year there has been transfer from level 1 to level 2 or level 3, depending on the nature, you need to disclose those transfers between the hierarchy, and no prizes for guessing any reconciliation on level 3, because that is going to be the most complex calculation for you. The beginning and ending balances reconciliation has to be given, and any gains or losses which you recognize for level 3 instruments in the P&L has to be disclosed separately for you. So that's quite critical. Yeah. As I said, 1, 2, and 3, these are particular items which I reflected. So I'll not probably, go through that slide again. This is maybe, say, one of the items which are observable and, you know, indirectly observable or unobservable options which are there. Fair value measurement, very clear, is if there a quoted price for the instrument, then obviously you'll use a quoted price. If it is not, is there an identical instrument available in the market for you? If there is, then use that fair value as a technique. If not, then the fair valuation standard gives you quite an options in terms of what techniques. Typically, in case of where you don't have enough inputs, people generally follow the DCF approach because that's more easier, or a discounted cash flow approach to probably justify and take care of it. So I think that's what I wanted to cover in terms of the session. I know there is lots to be probably crammed in. I think it's almost now close to 1.5 hours since I've been speaking. Yes, you might have found sometimes the pace to be a bit fast, but as I said, it's difficult to justify to cover all the topics of Ind AS in such a small session. But thank you so much for the patient hearing. I know I might be running a bit short on answers, but still, if there are any questions, I'm happy to answer them.
Sir, we have one question from participants. Is there any materiality limit for Ind AS 116?
So as I said, there is no materiality limit for 116 per se. There is a low value asset. There is nothing which is being defined specifically over there. There is a mention of $5,000 in IFRS standards, which is IFRS 16, which is there. Beyond that, there is nothing specific which is there. So there
Sir,
is
we
no
have one
materiality limit.
more.
Yeah,
Mhm.
please.
Accounting treatment for cancellation of share warrant from the issuer perspective and investor's perspective.
Okay, interesting one. I need to probably delve more into the terms of those share warrants, because warrants for the entity might qualify also as a financial liability on the balance sheet. Now, if it qualifies as a financial liability, then any extinguishment of a liability would typically go to the P&L. If it was equity, then any cancellation of it, you will have to probably see that the movement goes into equity. Similarly, for an investor, if it's a fair value through P&L asset per se, then obviously any cancellation, if they've not got anything, then it's a loss which they make goes to P&L. If it's an equity instrument and is into probably OCI, then the item goes into OCI. So depending upon the terms, you will have to probably analyze it and give an answer.
If you have, sir, should we wait for 2 or 3 minutes, right?
Yes, yes, fine, please.
If you have any other question, then you can write us. Sir, we are not getting more queries. Should we conclude?
Yes, please.
Thank you so much, CA Arvind Daga, sir, CA Achal Jain, sir. On behalf of ICI, thankful to you for giving your precious time and sharing your knowledge with us. I would like to thank C. Durgesh Kumar Kapra, sir, CA Rohit Rubatia, sir, and all members of council for such a great and learning session. I also want to thank all the viewers and participants who joined us and kept their support till the end. Thank you so much.
Thank you. Thank you.